Wall Street veterans understand that massive metal deliveries rarely happen without deeper institutional motives. When major banks move physical silver instead of paper contracts, the market usually enters a critical transition phase. The American financial system often resembles a towering suspension bridge carrying enormous weight across uncertain waters. Most investors only notice the bridge when cables begin tightening under extraordinary pressure. JP Morgan recently took delivery of approximately 14 million ounces of silver through the COMEX system. That number immediately captured attention across institutional trading desks and commodity research divisions throughout the United States. Experienced metals analysts recognize the significance because events of similar magnitude historically appeared during periods of financial uncertainty. The transaction was not merely another routine future settlement inside the commodities marketplace. It represented a substantial movement of physical metal into institutional possession during an environment filled with geopolitical tension and monetary instability. Professional investors understand that physical silver carries different implications compared with paper-based exposure. Paper contracts can expand rapidly through leverage, while physical inventories remain finite and difficult to replace. That distinction becomes critically important whenever confidence inside the broader financial structure begins weakening. The timing of this delivery also raised serious questions among macroeconomic strategists and commodity specialists. Inflation concerns continue affecting consumer behavior across the United States despite moderating headline statistics from federal agencies. Interest rates remain elevated compared with conditions experienced during the previous decade of monetary accommodation. Government debt levels continue expanding, while Treasury financing requirements steadily increase across multiple fiscal quarters. Central banks throughout the world have also accelerated precious metals accumulation during recent years. Gold has dominated most headlines, but silver remains deeply connected to industrial demand and monetary sentiment simultaneously. That dual identity gives silver a unique strategic position inside global financial markets. Unlike gold, silver participates directly in advanced manufacturing and technological infrastructure development. Solar panels, electric vehicles, semiconductor systems, and military applications all require meaningful quantities of refined silver. Industrial demand therefore creates structural pressure even before investment demand begins accelerating. When institutional buyers remove large amounts of physical silver from exchange inventories, analysts immediately examine supply availability. COMEX warehouses function as critical hubs for settlement confidence across the futures market structure. Large withdrawals can influence perceptions regarding liquidity and future delivery capacity. Historically, dramatic physical accumulation often occurred during moments when institutions anticipated rising volatility or tightening supply conditions. Veteran traders remember similar patterns during the financial crisis era and subsequent commodity surges. During those periods, physical ownership became increasingly valuable as uncertainty spread through credit and currency markets. The modern financial system depends heavily upon confidence and continuous liquidity circulation. Whenever major institutions prioritize tangible assets, observers naturally investigate the underlying motivations behind those decisions. JP Morgan possesses one of the most sophisticated commodities operations in the global banking industry. Its trading desks maintain extensive analytical capabilities covering precious metals, energy currencies, and interest rate markets. Large acquisitions from such institutions rarely emerge from emotional reactions or speculative enthusiasm. They usually reflect calculated positioning informed by broad economic intelligence and long-term strategic planning. Several market observers believe institutional demand for physical silver could indicate expectations of future monetary instability. Others argue that tightening industrial supply chains may gradually reduce available inventories over coming years. Both interpretations carry important implications for investors, policymakers, and commodity producers across international markets. Silver mining production has faced challenges related to energy costs, labor constraints, and declining ore grades. New mine development also requires substantial capital investment and lengthy regulatory approval processes. That reality limits the industry's ability to rapidly expand production whenever demand increases unexpectedly. At the same time, renewable energy initiatives continue driving additional industrial consumption throughout developed economies. The transition toward electrification depends heavily upon metals capable of supporting conductivity and energy efficiency. Silver remains among the most effective conductive materials available for industrial applications. This creates an unusual market environment where monetary demand and industrial demand reinforce each other simultaneously. Institutional buyers clearly understand this dynamic and monitor it with extraordinary attention. Another important factor involves the growing disconnect between physical metal and derivative market activity. Futures contracts can represent enormous volumes of silver without requiring immediate physical settlement. That structure generally functions smoothly during stable market conditions with abundant liquidity and participant confidence. However, stress emerges whenever too many participants seek actual delivery at the same time. Physical inventories suddenly become far more important than theoretical paper exposure under those circumstances. Large deliveries therefore attract scrutiny because they potentially signal changing institutional preferences regarding risk management. Banks and hedge funds constantly evaluate counterparty exposure during periods of elevated financial uncertainty. Physical ownership reduces certain categories of systemic risk associated with derivative-dependent market structures. This does not automatically imply an imminent collapse or dramatic crisis scenario. Professional analysts avoid sensational conclusions, unsupported by verifiable evidence or historical context. Nevertheless, experienced investors recognize that institutional behavior often communicates valuable information before public narratives fully adjust. Markets frequently move in anticipation of future developments rather than current headlines alone. That principle explains why sophisticated capital allocators monitor commodities and bond markets extremely carefully. These sectors often reveal underlying stress long before equity markets fully acknowledge changing economic realities. The United States economy currently faces a complex combination of resilient consumption and mounting structural pressures. Consumers continue spending while credit card balances and household financing burdens remain historically elevated. Commercial real estate markets also face refinancing challenges created by higher borrowing costs and changing workplace behavior. Regional banking stress during previous years demonstrated how quickly confidence concerns can spread across financial networks. Against that backdrop, substantial physical silver accumulation inevitably generates significant institutional discussion. Some analysts believe large banks may anticipate renewed inflationary pressure driven by fiscal expansion and supply disruptions. Others point toward geopolitical fragmentation, reshaping trade flows, and strategic resource allocation among major economies. Precious metals historically perform important roles whenever trust in monetary systems experiences gradual erosion. Silver, in particular, often attracts increased interest because it combines affordability with strategic industrial relevance. Retail investors frequently focus upon price volatility, while institutions concentrate upon long-term asset positioning and liquidity protection. That difference in perspective explains why major institutional transactions deserve careful examination rather than emotional interpretation. Financial history repeatedly demonstrates that strategic accumulation usually occurs before broad public participation emerges. By the time mainstream attention intensifies, institutional positioning has often been developing quietly for extended periods. The current silver environment reflects multiple converging forces rather than a single isolated catalyst. Industrial transformation, monetary uncertainty, fiscal expansion, and geopolitical competition all influence market behavior simultaneously. J.P. Morgan decision to take delivery of 14 million ounces therefore cannot be viewed through a simplistic lens. The move represents one piece within a much larger global financial puzzle now unfolding across commodity markets. Professional commodity analysts continue monitoring warehouse inventories, lease rates, and future spreads for additional confirmation signals. These indicators help determine whether broader physical tightness may eventually emerge across international silver markets. Investors should also recognize that short-term price movements rarely capture the full significance of institutional positioning changes. Large banks often operate according to timelines extending far beyond daily market volatility and media narratives. Strategic commodity accumulation can reflect expectations developing over several years rather than several trading sessions. That perspective becomes especially important during transitional periods within the global monetary and economic system. Financial landscapes rarely transform overnight, despite dramatic headlines and emotional commentary from market participants. Instead, major shifts usually unfold gradually beneath the surface before becoming obvious to the broader public. The significance of this silver delivery may therefore extend beyond immediate pricing implications or speculative excitement. It may represent another indication that powerful institutions are preparing for a more uncertain financial environment ahead. Financial history demonstrates that large institutional movements inside precious metals markets rarely occur without broader strategic considerations. The last time market participants witnessed comparable physical silver activity, the global financial environment was entering a period of extraordinary instability. Veteran commodities traders still remember how rapidly confidence conditions changed during previous monetary disruptions. Economic stress often develops quietly beneath optimistic headlines before suddenly reshaping investor behavior across every major asset class. That pattern resembles pressure building behind a massive American dam, holding back enormous financial currents. From the surface, conditions appear controlled and stable. Beneath the structure, however, invisible pressure continues expanding until markets can no longer ignore underlying realities. The modern silver market operates inside a highly interconnected system involving futures exchanges, industrial consumers, mining companies, and institutional investors. Every major movement within that structure carries implications extending far beyond a single commodity transaction. When JP Morgan accepted delivery of 14 million ounces, many professional analysts immediately began comparing current conditions with previous periods of monetary stress. Historical context matters because institutional behavior frequently repeats recognizable patterns during uncertain economic cycles. During the financial crisis era, precious metals experienced significant accumulation as investors questioned the stability of banking systems and fiat currencies. Silver prices eventually surged dramatically as both industrial demand and investment demand intensified simultaneously. Although current circumstances differ from previous crises, several underlying themes appear increasingly familiar to experienced market observers. Persistent government deficits remain one of the most important concerns among institutional macroeconomic analysts. The United States continues financing enormous fiscal obligations through expanding debt issuance across treasury markets. As debt levels rise, governments become increasingly sensitive to higher interest rates and refinancing costs. This creates difficult policy challenges for central banks, attempting to balance inflation control with economic stability. If rates remain elevated, economic growth may weaken. If rates decline too quickly, inflationary pressures could accelerate once again. Such policy dilemmas often encourage institutions to diversify portions of capital into tangible assets possessing intrinsic value. Silver historically benefited during periods when investors questioned long-term currency purchasing power. Unlike digital financial instruments, physical metals cannot be created through monetary expansion or leveraged credit systems. That characteristic gives precious metals enduring appeal during uncertain monetary environments. Another major factor involves global geopolitical fragmentation, reshaping supply chains, and strategic resource planning. The international economy increasingly reflects competition between major powers seeking control over critical industrial materials and manufacturing infrastructure. Silver plays an essential role within advanced technology sectors, critical to national economic and military priorities. Semiconductor production, renewable energy, infrastructure, telecommunications, systems, and defense technologies all require reliable silver supply. As governments accelerate industrial investment, strategic metals become increasingly important within long-term national planning. Institutional investors recognize these structural realities and position accordingly. Mining supply trends also deserve serious attention within this discussion. Global silver production growth has remained relatively constrained despite rising industrial consumption expectations. Many silver deposits exist primarily as byproducts of copper lead or zinc mining operations. That structure limits the industry's ability to quickly increase dedicated silver output whenever demand expands sharply. Environmental regulations, rising operational costs, and declining air quality further complicate future production growth. Developing new mining projects often requires many years before meaningful commercial production begins. Meanwhile, industrial consumption continues increasing through electrification and renewable energy expansion. Solar technology alone represents a major source of future silver demand, according to numerous industry projections. Electric vehicle adoption also contributes additional structural consumption pressure across manufacturing supply chains. This combination of constrained supply and expanding industrial utilization creates a potentially supportive long-term environment for silver markets. Institutional participants clearly understand these dynamics when making large-scale physical acquisitions. Another issue attracting attention involves the relationship between paper, silver contracts, and available physical inventories. The futures market allows enormous quantities of silver exposure through leveraged derivative structures. Under normal conditions, most contracts settle financially without requiring physical delivery. However, confidence in that structure depends upon participants believing physical settlement remains available when necessary. Large physical withdrawals can therefore influence broader perceptions regarding market liquidity and inventory sufficiency. This does not guarantee immediate shortages or market dislocation. Nevertheless, experienced commodity professionals carefully monitor warehouse levels and delivery trends because they often reveal important shifts in institutional sentiment. The distinction between owning a contract and owning physical metal becomes increasingly significant during volatile financial conditions. History repeatedly demonstrates that investors prioritize direct ownership whenever systemic uncertainty begins rising. That principle applies across banking, commodities, energy markets, and sovereign debt systems. Confidence remains the foundation supporting every modern financial structure. Whenever confidence weakens, institutions naturally seek assets perceived as durable and independent from counterparty risk. Silver historically served that purpose during periods of monetary transition and geopolitical instability. The psychological dimension of precious metals ownership also deserves consideration. Unlike many modern financial products, physical metals possess thousands of years of historical monetary credibility. Long before electronic banking systems existed, civilizations stored wealth through gold and silver reserves. That historical memory still influences institutional and retail investor behavior during uncertain economic periods. Central banks themselves continue accumulating gold, partly because tangible reserves provide strategic confidence during unpredictable geopolitical conditions. Silver may not occupy the same official reserve status, but it benefits from similar perceptions regarding intrinsic value and scarcity. Professional investors understand that markets often move according to changing psychology as much as changing statistics. The emotional environment surrounding inflation debt and currency stability can significantly influence capital flows into tangible assets. Recent years demonstrated how rapidly investor sentiment can change when inflation accelerates beyond official expectations. Many Americans experienced rising living costs despite repeated assurances that inflationary pressures would remain temporary. That experience affected public confidence regarding economic forecasting and monetary policy credibility. Institutional investors carefully monitor these psychological shifts because they influence long-term asset allocation behavior. Large commodity positions frequently emerge from broad strategic concerns rather than narrow short-term speculation. J.P. Morgan involvement therefore attracted attention not simply because of the quantity involved, but because of the broader macroeconomic environment surrounding the transaction. Several analysts believe the global economy may be entering a prolonged era defined by higher volatility and structural inflationary pressure. Deglobalization, labor shortages, energy transitions, and geopolitical competition could all contribute to persistent cost pressures across industrial economies. If that scenario develops, precious metals may continue attracting institutional interest as portfolio hedges against systemic uncertainty. Silver occupies a particularly unique position because of its combined industrial and monetary characteristics. Gold primarily functions as a monetary reserve and inflation hedge. Silver, however, also participates directly in technological expansion and manufacturing growth. The dual role creates potentially powerful demand dynamics during periods of industrial transformation. Financial institutions recognize these characteristics and increasingly analyze silver through both commodity and monetary frameworks simultaneously. Investors should nevertheless avoid simplistic conclusions or emotional predictions regarding immediate price explosions. Markets rarely move in straight lines, and institutional positioning can develop gradually over extended periods. Short-term volatility often obscures larger structural trends unfolding beneath daily headlines. Professional capital allocation requires patience, discipline, and careful analysis, rather than reactive speculation. The significance of J.P. Morgan physical silver delivery ultimately depends upon whether additional institutional accumulation follows in coming months and years. If broader inventory tightening emerges, analysts may eventually view this transaction as an early indicator of deeper structural changes within commodity markets. Financial history consistently rewards observers who pay attention to institutional behavior before mainstream narratives fully adjust. Major transitions usually begin quietly among sophisticated market participants, long before public awareness reaches significant levels. That reality explains why experienced analysts continue monitoring precious metals with increasing attention amid evolving economic uncertainty. The silver market may appear small compared with global equity or bond markets, yet history repeatedly shows that important signals often emerge first from overlooked corners of the financial system. Large physical silver deliveries therefore represent more than isolated commodity transactions. They potentially reflect changing institutional assumptions regarding inflation, liquidity, monetary stability, and long-term economic risk. Those assumptions may ultimately shape the next chapter of the global financial landscape. Institutional finance operates according to a principle rarely understood by the broader public. Major banks and asset managers do not position themselves for headlines of today. They position themselves for conditions expected several years into the future. That reality explains why the recent J.P. Morgan silver delivery deserves serious attention from investors, economists, and policymakers alike. The transaction itself represents more than a movement of metal through exchange warehouses. It symbolizes a possible shift in institutional thinking during a period of mounting global uncertainty. America currently stands at an important economic crossroads shaped by debt expansion, geopolitical rivalry, and changing monetary conditions. The financial system resembles an aging skyscraper enduring stronger winds with every passing season. From the street level, the structure still appears stable and impressive. Inside the foundation, however, engineers continue reinforcing stress points against future pressure. Large financial institutions behave similarly during uncertain economic cycles. They strengthen positions quietly before broader instability becomes visible to the public. J.P. Morgan's long history within precious metals markets gives additional significance to this development. The bank possesses extensive experience navigating commodity cycles, inflationary periods, and monetary transitions. Its trading operations employ some of the most advanced market intelligence systems in global finance. When such an institution chooses to secure substantial physical silver inventories, analysts naturally examine the broader strategic implications. One possible interpretation involves expectations regarding future inflation persistence. Although official inflation measures moderated from previous peaks, structural inflationary pressures remain embedded throughout many sectors of the economy. housing costs, healthcare expenses, insurance premiums, and energy infrastructure investments continue affecting household purchasing power across the United States. Massive government spending programs and rising debt servicing obligations may also contribute to future monetary expansion pressures. Historically, precious metals often gained institutional interest whenever long-term currency purchasing power became uncertain. Silver particularly attracted investors during periods when monetary confidence weakened alongside industrial demand growth. That combination may once again influence strategic positioning inside institutional portfolios. Another critical factor involves growing concerns surrounding global reserve currency dynamics. The United States dollar remains the dominant international reserve currency and primary medium for global trade settlement. However, several nations increasingly explore alternatives designed to reduce dependence upon dollar-based financial systems. Central banks across multiple regions continue increasing gold reserves while developing bilateral trade agreements outside traditional Western financial frameworks. These developments do not suggest an immediate collapse of dollar dominance. Nevertheless, they indicate gradual shifts within the architecture of international finance. Periods of transition inside reserve currency systems historically encouraged greater interest in tangible stores of value. Silver may therefore benefit from broader institutional diversification strategies connected to geopolitical realignment and monetary hedging. Industrial transformation also remains central to the long-term silver narrative. Modern economies increasingly depend upon electrification, renewable energy infrastructure, and high-efficiency electronic systems. Silver remains essential because of its superior conductive properties and widespread technological applications. Solar panels represent one of the fastest-growing industrial sources of silver demand globally. Electric grid's battery systems, advanced computing technologies, and defense manufacturing further expand long-term consumption requirements. At the same time, supply growth remains relatively constrained compared with projected future demand trends. This imbalance creates conditions that institutional investors monitor with considerable interest. Commodity markets frequently experience delayed reactions to structural supply challenges. Inventories may appear sufficient for years before suddenly tightening under accelerating demand pressure. Once shortages emerge, markets often reprice rapidly because expanding physical production requires significant time and investment. Institutional buyers therefore prefer positioning before supply stress becomes obvious to the broader market. That strategy historically produced significant advantages during previous commodity supercycles. The psychology of institutional investing also plays an important role within this story. Large banks constantly evaluate systemic risk exposure across currencies, bonds, derivatives, and credit markets. After multiple financial disruptions during recent decades, institutions increasingly appreciate the value of tangible collateral and hard assets. Physical silver provides direct ownership independent from many forms of counterparty risk. Unlike complex derivatives or leveraged financial instruments, physical metal cannot disappear through bankruptcy accounting adjustments or liquidity freezes. This characteristic becomes increasingly attractive during periods of elevated geopolitical and financial uncertainty. Investors should also understand that institutional commodity accumulation rarely occurs in isolation. Large transactions often reflect broader portfolio adjustments involving currencies, interest rates, sovereign debt, and macroeconomic risk management. Commodity exposure can serve as insurance against scenarios involving inflation, supply disruption, or declining real interest rates. Silver's unique position between industrial necessity and monetary history makes it especially attractive during transitional economic periods. However, disciplined analysis remains essential when interpreting these developments. Financial markets naturally generate exaggerated narratives whenever large commodity transactions become public knowledge. Professional investors avoid emotional speculation unsupported by historical evidence or market fundamentals. No single transaction guarantees immediate price explosions or financial collapse. Markets remain influenced by numerous variables, including central bank policy, economic growth, industrial activity, and investor psychology. Nevertheless, institutional behavior often provides valuable insight into evolving long-term expectations. Major banks possess access to extensive economic research, geopolitical analysis, and global market intelligence. Their actions frequently reveal more than public commentary or short-term media narratives. That principle explains why experienced market observers continue monitoring physical precious metals flows with growing interest. The broader significance of the J.P. Morgan delivery may ultimately depend upon future developments across multiple interconnected sectors. If inflation pressures remain persistent, precious metals demand could strengthen further. If geopolitical tensions continue disrupting supply chains, strategic resource accumulation may accelerate among institutions and governments alike. If industrial electrification expands, according to current projections, silver consumption may rise substantially over coming decades. Any combination of these factors could reshape long-term market dynamics in meaningful ways. Financial history repeatedly demonstrates that periods of major transition create both extraordinary risks and extraordinary opportunities. Those who recognize structural changes early often preserve and expand wealth more effectively than those reacting after trends become obvious. The current environment increasingly resembles previous historical moments when institutional capital quietly repositioned before broader public awareness emerged. That does not guarantee identical outcomes because every economic cycle contains unique characteristics. However, history frequently rhymes through repeating patterns of debt expansion, monetary uncertainty, and resource competition. Silver occupied important roles during many of those previous transitions. The recent J.P. Morgan transaction therefore represents more than an isolated commodity event. It reflects the growing importance of tangible strategic assets within an increasingly uncertain global financial system. Professional investors, policymakers, and market analysts will continue studying these developments carefully as economic conditions evolve. The coming years may ultimately determine whether this silver accumulation marked the beginning of a larger institutional movement toward hard asset security. If so, future historians may look back upon this period as another pivotal chapter in the long relationship between precious metals and financial stability. For now, one reality remains increasingly clear. When powerful institutions begin moving aggressively into physical assets, the smartest observers pay very close attention.